Hi friends, this is C. Ashwini Rastogi. This video is useful for you if you are a seller and non-resident. So if you are a property in India and you going to sell this property to resident or non-resident, then your TDS would be higher. So first of all, you need to calculate the TDS, whether it's a long-term capital gain or short-term capital gain. If you sold this property for after holding of period 24 months, then this would be long-term capital gain and taxable at 20 plus rate. So what would be the TDS rate which is required to deducted by buyer? So in case if your sale consideration, so TDS is deducted on sale consideration. If your sale consideration is below 50 lakh, then TDS would be 20.80%. If it between 50 to 100 crore, it would be TDS 22.88%. And in case 1 to 2 crore, 23.92, 2 to 5 crore, it would be 26%, and more than 5 crore, there would be TDS rate 28.5%. So surprise, you understand why it is higher rate. So basically in long term capital gain there would be TDS is 20%, but in short term capital gain there would be slab rate. So what the government is intention behind that, there is a higher surcharge. Although TDS should not be deducted at seller sale consideration, it should be after the adjusting of indexation cost of purchase, but the law is this, so we understand in this manner. So what is solution for that? We can approach to the income tax jurisdictional officer for getting a lower rate TDS deduction certificate. The department, income tax department, issue lower rate TDS deduction certificate, usually 3 to 5%, but it should not be the TDS rate below the actual computed TDS. So what would be the TDS if you are approaching for the AO? That you must need to compute the TDS, whether it is a capital gain in the nature of STCG or LTCG. So first of all, there would be circle rate as defined in the local stamp duty act, minus cost of acquisition after computing the indexation cost. So these particular document we need to submit before the assessing officer. First of all, your proof you are resident. So your OCI passport would be sufficient in that purpose. If you don't have OCI passport, then your passport with the complete copy for last 4 years, number of days stay in India. So definitely if your stay less than 182 days, then you become the non-resident. So for that purpose, your ID, address proof, and your cost of acquisition of that property. That income tax department just want to know how much the cost you have paid to the for buying that property, and it should be supported by bank statement. Highlight the figure that has been paid to you from your source of income. So not need to worry, only the payment you need to highlight in the bank statement. So after the computation of long term capital gain or short term capital gain, as the case may be, department will see there is a no capital gain, so they will usually give a 1 to 5% rate. Suppose your capital gain is not taxable at all, then why need to deducted by buyer? Then in that case, department is just give a 1% TDS rate, so buyer will deduct only on 1%, not 20-25%. So this will be the good suggestion for every non-resident seller to income tax refund. You can file ITR and get back the income tax refund if any. So thank you very much. If you have any query, you can mail us.